Jeff noticed he is a director of supply chain within Ryerson. He's been in the business, let's see, 24, 25 years. So he's a wealth of information, far better within the metals world than I am. And I think what you'll really be able to glean from him, I oftentimes touch on the ingot side of the aluminum market. What Jeff gets the luxury of doing is, I don't know if we can call it a luxury, but he gets to spend more of his time dealing and interfacing directly with the physical mills. So anything regarding lead times, product quality, things like that, he's going to be much more suited to answer those types of questions. But Jeff, kick it over to you.
Sure. Yep. And Nick, I appreciate it. We're going to start off with aluminum extrusions, just kind of a brief overview of where we have seen really probably the last 6 months to a year to where things have gone, even let's call it the last 30 to 60 days. But on the extrusion side, and in particular on the soft alloy extrusion side, we saw relatively strong demand. We saw some labor shortages that were occurring at the mill level. Those have continued all the way through the first half of 2022. But going into the second half of 2022, we're starting to see that loosen up. Lead times have improved pretty significantly over the last 30 to 60 days. Not only at kind of the major soft alloy extrusion mills, but also from the regional extruders. The one exception there would be on the hard alloy or the cold finished bar products. Those lead times continue to be pretty extended, and on-time delivery seems to be a struggle at the cold finish side of the equation. As far as just standard shapes go, bar products, channel, angle, those type of products, those lead times are now back down to what we call traditional levels. Let's call it 3 to 5 week range. Some are actually even better than the 3 to 5 week range, but that's the average. On the custom shape side, extended lead times have continued. But I would tell you over the last 30 to 60 days, those values have come in 7 to 8 weeks. So on average, custom shapes are running, let's call it 25 to 35 weeks. We do have one press that I saw this week that's still out to a 45-week time frame. Allocation has been in place. We've seen that really over the last year or so. But as lead times start to come in, I would expect some of our major soft alloy extrusion mills to start to eliminate some of the allocation, and will live off of what the production lead time is, along with some of the depot that is starting to build. From a depot standpoint, I wouldn't say we're quite at pre-pandemic levels, but some of the majors, some of the Kaisers and the Hydros of the world are starting to build their depot inventories back up. Spanish Fork, Persona, some other locations that it's building. And we do anticipate going through the second half with some of the softening that we're seeing in the market, that those depots will continue to build. For US, Canada, for the first half of 2022 versus 2021, we have seen shipments up. Primarily, that's being driven from automotive demand and building construction demand. But we also are seeing it in some other areas like manifold bar for the fluid power market. As we go into the second half of 2022, again, if you talk to many of our soft alloy extrusion mills, they do anticipate that the market will soften, and that we'll see lead times continue to be narrowed down. Depots will continue to build, and there might be a little bit of a retraction on how much shipments go out. Next slide. Really almost the same story as it relates to plate and flat mills. In particular on the plate side, strong demand allocation has been in place, certainly through the first half of 2022. On the common alloy side, though, we are starting to see some softening on that market segment as well. Not so much on the plate or the heat treat plate side. Import offerings, those have really been dramatically reduced all the way back to when anti-dumping and countervailing duties were applied. That would have been back in first quarter of 2021. It's really made many of our import providers uncompetitive to a domestic alternative. And then if you include some of the 232 tariffs, favored nation that would be in play, vessel costs, container costs, and some of the delays that we've had in getting material through port, it's just made them less and less attractive for current state as it relates to the common alloy side of the equation. Domestic mills still sold out although again, there is some loosening on the common alloy side. And hot mill capacity, really on the hot band side, that was more of a story maybe 9 to 12 months ago. But there is some announcements with some maintenance that will be happening here in the second half of 2022 for hot mill capacity. As a general rule on the common alloy lead time, we're running right around 8 to 10 weeks across all domestic mills on the DC side. On the continuous cast side, that's a little bit in a tighter supply as there's less suppliers that are producing continuous cast product. Heat treat plate is extended. All three of the major domestic mills that produce heat treat plate have indicated to me that they're fully allocated out, primarily based off of strong demand on the semiconductor sector. But there has actually been a little bit of an uptick on the aerospace side as well. And they do anticipate that allocation and tight supply for things like 6061, 2024, 7075 heat treat plate, that those will continue to be tight throughout 2023.
Hey, Jeff, a good quick question for you. On the flat side, I know Ryerson doesn't do a ton into tier one automotive, but can you speak to anything on the flat side with regards to automotive demand, whether we're seeing any pickup there? Is the shift to EV or lightweighting of vehicles having much of a noticeable impact within the flat?
I think it is. I think, the general theme that we've heard is on the automotive side. The demand may be out there, but they are struggling like many companies out there with getting other supplies to finish off the product. That seems to be continuing. I think there's optimism that might be turning the corner in the first half of 2023, but I hear less and less optimism that that's going to be an uptick going through the balance of 2022.
Got it. Thank you.
Surcharges, I won't go into a lot of detail around surcharges, but as we get into the contract time frame where we're doing some negotiation for 2023 type of agreements, we are kind of seeing a new wrinkle or a newer wrinkle with the surcharge side of the equation with magnesium in particular, but some of our suppliers are calling it a hardener surcharge, which could consist of magnesium, manganese, silicone, copper. The challenging part as we go through balance of this year and as we go into negotiations for 2023 is each one of our domestic partners, and I would say that there's 5 of them that are out there, are doing things completely differently from the other supplier as it relates to surcharge. So we're kind of working through that. There's a lot of different wrinkles that are going on, but in the example of Arconic, they will be changing their surcharge mechanism going into 2023. And instead of including just magnesium, it will include magnesium, manganese, silicone, and copper, and a fuel and freight surcharge component to it. So it's getting a little bit more complex. These surcharges vary by mill as far as when they make the changes. Some of them are changing on a monthly basis. Some are changing them on a quarterly basis. Some are putting them into a family. So any 3 series would be at one surcharge. 5,000 would be at another surcharge going into 2023. Some of them are going from that family of an alloy over to specific alloys. So 5052 would be a specific surcharge, 5083, 5086, and so on. So just something to look out for, but it's definitely a new wrinkle in comparison to what we worked on from a costing standpoint for common alloy products in the past.
Yeah, and it's a good segue from some of the topics I had touched on with regards to kind of energy prices, electricity prices, because if you remember back, what was it, September or October of last year, when energy markets within China got tight and they had to start rationing production of certain things, that was when we got the original magnesium issue. So I would say that risk may not be huge yet, but it's still certainly on the table. Yeah.
The other thing I mentioned, mag being the primary one that's out there, we are starting to see that number start to reduce. At a high, if you go back to March of this year, that number would have been around 910. Now it's down to around 650, 750 range. So there has been a little bit of a correction in the mag side of the equation. Next slide. So this is more of just a couple of announcements that came out on some fully integrated facilities that will be coming into play it's a little ways off. Both of them are into 2025, but both of them are primarily going to be focused in on can sheet production along with auto sheet production. Steel Dynamics has indicated some of their production will go into common alloy products. And Novelis, even though that the primary production will be can sheet and auto sheet, it will provide some relief off of their Kingston and Oswego facilities that do produce common alloys. So there should be some benefits as we go towards 2025. A lot of this push is going to be off of a green initiative, low carbon. I know in the case of Novelis, their push is to be carbon neutral by 2050. You heard a lot of that theme from many of our domestic partners. Again, those are off into 2025. Steel Dynamics, we're hearing that will be a play for Q1 of 2025. The numbers, they may look big, but if you do take some of what the analysts are projecting out there, we do believe that there's going to be a deficit about 2 million tons that are needing to be replaced. We're not getting a lot of imported product that's coming in. So this will support it, but it's going to be a couple of years off. So there could continue to be a pretty tight supply on common alloy, especially if we get markets like can sheet and automotive that start to spike.
Awesome. Really great information. Mike, I don't know, do you want to do any questions now, or should we hold until the end?
Yeah, we got a few, but I was going to note here, it's nice to see that can production is on both of these. I literally read an article the other day that brewers across the country are dealing with a shortage of aluminum cans. So just a little anecdote there. A question from the audience, speaking specifically to a fire at the Faircrest mill of Timken Steel. Do you know if that's affected deliveries at all?
You want to touch on that, Nick, or you want me to?
You got it.
Yeah, I think that we believe it will to some capacity, but I think we're still working through what effects that's going to have overall. It certainly was a pretty significant announcement that came out on the steel side, but we are working through it. That's kind of my latest update on it.
Gotcha. And there was another question about, do you when you anticipate aluminum mills starting to lock up 2023 contracts? Is there any word on that?
It's happening right now, and we've already started it, both on the direct chill and on the continuous cast side.
Gotcha.
Less on the soft alloy extrusion. That seems like that's a little bit more delayed, but we are definitely into the contract the season currently.
Yeah, and I would say that's true for carbon, and that's true for stainless as well.
Okay, great. Yeah,
did Jeff just have an enforced power outage on his end?
Oh, that's just energy. We're trying to conserve.
I thought they were doing rolling blackouts in Minneapolis.
Yeah. I would add though, I mentioned the common alloy. We are in negotiation period, but if there are people that are on the call right now that may buy heat treat product, so 60, 61, 2024, 70, 75, because of how tight that market is, if you haven't looked to procure for 2023, probably now is a very good time to get ahead of it.
Great stuff. Jeff, we asked you around for another, let's say 15, 20 minutes for when we wrap up the rest of the metals, and then there could be some further Q&A for you.
Absolutely, yeah, I'm on.
Awesome.
My lights might turn off. But
perfect. So continuing on the aluminum ingot side of things, we've looked at this chart many times in the past, but this is ultimately the price of LME aluminum ingot. So basically the commodity piece of aluminum. It's come off fairly rapidly in the last several months on the back of, I would say mainly on the back of China continuing to lock down, dollar strength. Those things are having kind of a dual pronged impact on the price of aluminum. And as we sit here today, literally on this day, this is the lowest price we've seen for LME aluminum ingot in the last year. So are we getting into value territory? Are we nearing a bottom? If we use today as a proxy, it's looking like no. But I've got a couple things that I'll share here in a few slides that might suggest, we potentially are nearing an area where we find some support. Looking down at the below section, this is, again, the relative strength index. So this is a gauge of momentum to determine whether things are overbought, oversold, kind of sitting in neutral territory. And with an RSI, relative strength index, of around 36, as we sit here today, a 30 is what's generally considered to be oversold. And so we're nearing that range. So from a technical standpoint, it wouldn't be totally shocking if you see some traders step in and start buying some of these contracts. That's mainly from kind of a momentum, kind of counter-cyclical standpoint. From the fundamental side of things, I know we talked about this chart last month, and we've talked about energy markets quite a bit on this discussion. But I want to revisit this because I think it's an important one, which is the higher or longer energy markets stay elevated, or perhaps even go higher, and it becomes difficult for aluminum smelters to procure energy to melt or to smelt. The more difficult it is for them to make money when prices are around $1 to $1.10. It's estimated that right now, on a global basis, about 23% of smelters globally are unprofitable at current levels. So what that means, just kind of eyeballing it, let's say, this chart represents all of global production going left to right. That's about 70 million tons of production. Basically, you're saying only about 50 to 55 million tons is currently profitable. And that's at like $1.05 to $1.10. If we start getting to $1 or even below $1, you actually work your way pretty far down this curve, all the way down to where about 50% of aluminum smelters become unprofitable. Now, in the short term, they can do that. They can produce some tons for a couple months and do it unprofitably. But if that persists, a lot of these smelters will start to ask the question, should I curtail production because I'm not making money doing it? And I think that's a real risk within aluminum. I think that's a risk within zinc, and maybe to a lesser degree in copper and nickel. But it's certainly an issue within aluminum, just given its energy intensity for making the product.
Well, you've seen some of that already, right, Nick? I mean,
exactly, yeah.
Century Aluminum came out with their shutdown. I think Norway globally. There was some smelters in China as well. I just don't think they've been significant enough yet to, cause a spike back up in LME rates.
Yeah, you can imagine behind the scenes, a lot of these, management teams are probably having the discussion, but no action yet taken at this stage. Probably a lot of eyes looking at the power markets as we see here today. Similarly, other things declining will be the Midwest premiums. Part of the premiums declining is in direct conjunction with the fact that the LME price, the LME ingot cost, has gone down because there is a tariff on aluminum if we import it. So as the price of ingots coming down, that tariff also decreases. The other factor, which I think we've talked about in prior discussions, is the freight markets they seem to be loosening up a little bit. And what we're looking at here is the truckstop.com index for freight. So this is looking at the number of available loads relative to the demand for those loads, and they compile an index. And that index is suggesting that if we assume this relationship holds up, we should probably continue to see pressure on Midwest premiums as we roll through the coming weeks and months ahead. So right now, I think the official number today just dipped below 25 cents. So it's been a little bit since we've seen prices below 25 cents on premiums, certainly this year.